Two big reports out on housing, mortgage rates, and pending home sales. Mortgage rates trending up ahead of the Fed's next meeting, inching higher for the second week in a row. We're now looking at 6.43% on the 30-year fixed mortgage rate. While higher rates, they've also been keeping buyers on the sideline. Pending home sales falling more than 5% in March, snapping a 3-month rebound. Here for a deeper dive into housing and what we could see here in the coming months, we want to bring in Bob Broeksmit. He is Mortgage Bankers Association CEO and President. Bob, it's good to see you here. So higher rates, obviously not exactly what home buyers want to hear. We've kind of been stuck in this mid 6% range now for quite some time. Where are we headed now? Are we going back to 7%?
No, in a word. I don't think we're going back to 7%. Thanks for having me on, first of all. And I want to stress that the interest rates on home mortgages now are a good deal higher than the 10-year Treasury. There's usually a spread of about maybe 180 basis points between the 10-year Treasury and the 30-year fixed rate mortgage. And it's closer to 300 basis points now. So there's a lot of room for mortgage rates to improve, even if the 10-year Treasury stays where it is. And we are expecting by the end of this year for rates to be closer to 5.5 as that spread does come in.
Bob, Diane Kinghall here. So the issue, though, with the housing market, we're seeing some weakness with regard to demand. I mean, pending home sales came in weaker today, down about 5% month over month, sharply year over year. So what is your expectation about the housing market as it stands with regard to demand?
Well, what we're hearing at the Mortgage Bankers Association from member after member is that they have a very full pipeline of qualified borrowers who have their loans approved subject only to finding a house, and that the inventory of houses for sale is at a stubborn low point. So I think the latest numbers from the realtors were 2.6 months. So I don't attribute the decline in pending home sales to a lack of demand as much as I do a lack of inventory. We're hearing this in many different parts of the country where if a house does come on the market, while it's not the overheated 12 or 15 offers way above asking price that it might have been a year ago, it still moves very quickly with more than one offer. So we're really hoping that as the spring advances, that more homeowners will put their homes on the market, and we think that will juice the market nicely.
Bob, what's it going to take in order to get more homeowners to put their homes on the market? Because a lot of homeowners are locked into those lower mortgage rates. That's obviously a challenge, really holding back those inventory levels. So what do you think is it going to take in order to really see that side of the situation improve?
Well, that's really the $64 question, I think, because it is true that a lot of homeowners have either purchased or refinanced in the last couple of years and have very attractive interest rates. At its bottom, though, home ownership and home buying has an emotional component. And I expect as people continue to do the math, and especially if interest rates come down a little as we expect them to, that some of the pent-up demand from home owners who would rather have the bigger house around the corner or move into a different school district or move closer to their work or whatever the traditional reasons are, that will pick back up. But we certainly do have to acknowledge that the low interest rates on most homes in America today do put a headwind into increasing inventory. Now, one thing I will mention, though, is that we're seeing a lot of good activity from our home builder members, and they are reporting that they not only are building faster than they had in the past, but also that they're building some spec homes, which wasn't always the case. So you're seeing some improvement to inventory on the new home side of things, which may help the process some.
Bob, I got to ask, I'm having trouble wrapping my head around the expectation that rates are going to come down. I know you're expecting them to come down later this year, especially with the Fed really expecting to raise rates as its coming meeting. How are you arriving at that prediction with regard to mortgage rates?
Sure. Well, we think the Fed is at or near the end, perhaps a quarter in May, or perhaps holding. You've heard Chairman Powell say that he believes that the tightened credit conditions that will be occasioned from the recent bank failures will act similarly to another rate cut. So it'll have a slowing effect. And the other thing we look at is that the Fed has long wanted to get in a position where the Fed funds rate was higher than the rate of inflation, so that it really was in a tightening mode on the economy. And we think they're either there or just about there. If you look at some of the core PCE numbers around 5%, you look at Fed funds closer to 5.25%, we think that they are at a place where they can stop and assess the effects on the economy. And between them being at or near the end and the thing I mentioned before about the really distorted spread between 10-year treasuries and 30-year fixed, those two things are the basis for our predictions.
Bob, there's some changes coming out to mortgage fees next month, a lot of that tied to credit score. How do you see that impacting home buyers and what that means for the housing market here?
Well, thanks for asking, because there's been an awful lot of misinformation out there on this, and I'd like to try to clear some of it up. First of all, these price changes from Fannie Mae and Freddie Mac were announced in late January, and they take effect with deliveries to Fannie and Freddie of May 1st. Well, if one of my member lenders is going to deliver a loan to Fannie Mae or Freddie Mac, that mortgage banker priced the loan to the consumer probably 6 weeks ago. So these fees are already in the market. So there's no magic May 1st date that any consumer needs to worry about. The second thing is that it is still the case that with the same down payment, borrowers pay less if they have a higher credit score. There's been some confusion about the changes and some notion that it's actually better to have a lower credit score or to put less money down in terms of loan pricing. And that's simply not the case. So the changes were meant to address some anomalies in the previous pricing structure. And now you'll see a very smooth increase in price as the credit score worsens. So it makes pretty good sense now.
All right, very important to clear some of those misunderstandings up right now. Bob Broeksmit, great to have you. Thanks so much for joining.